Hi there, John Hardy here with the FX update today, Thursday, April 7th. Finally, we headed to the ECB meeting today and Bank of England as well, and of course all the anticipation adds up to watching paint dry after the evening. Virtually no reaction in the market in terms of the euro, in terms of crosses versus the dollar. It's basically flat from before the decision. Euro sterling not going much of anywhere either. And not a huge takeaway, so unfortunately not panning out to being a trigger of volatility here. Otherwise, though, it seems to be interesting that we're seeing the risk rally tiring a bit here. Of course, this is the first day it's done it in a long time, but it's just interesting and one of the developments worth noting on the day. Getting down to business, today's highlights. Last night before very late U.S. hours and even later European hours, obviously, we had Portuguese representatives formally requesting a bailout, as they could see that their funding was drying up and they would not be able to meet the requirements for keeping the country a going concern financially. But the market shrugged it off. This was largely anticipated, as we saw in the recent run-up in Portuguese bond yields. And in general, even as the Bloomberg articles pointed out this morning, while the whole Portuguese situation has been unfolding, we have Spain, the spreads in Spanish debt, and the market sentiment towards the non-three little pigs, if you will, continuing to improve. So this is why we're not seeing much of a market reaction. There was a little bit of a dip in euro today. I'm not so sure it was on Portugal, though. It was just a little bit of anticipation before Trichet was out crossing the wires on his press conference and before the actual hike that was expected was seen. Other news, we saw an Australian employment report out, very strong, especially on the full-time jobs perspective, as well as the labor participation rate going up slightly and the unemployment rate going down. And this saw Aussie able to find new legs even on top of what it's seen lately, and crossing that 105, where one might guess there were some barriers there, barrier options. Later in the day, with risk coming off a bit, though, it's coming back down. We'll take a look at the charts in a moment. A bit interesting there, but the data, of course, supportive. Bank of England, there was no hike. There might have been a tiny minority looking for a hike, and we saw sterling weaken a bit after the actual news came across the wires. Not a huge change on the day, though. And of course, we don't get guidance from the Bank of England because they don't usually issue any kind of statement. ECB out with the hike, and now we have, after Trichet's boring press conference in which he tried to put us all to sleep, we have expectations maybe off 2 or 3 bips from where they were before. So not exactly an earth-shaking performance from Mr. Trichet, whose hawkishness was basically in line with expectations. Lackard out talking a bit tougher, but this is not being priced in as interesting by the market. That's Fed, one of the Fed presidents, by the way. Also interesting, U.S. perhaps signs of more resilience than we're giving the U.S. economy credit for. We saw the consumer comfort index rising a bit further. Now, historically, this comfort index is best correlated with the situation in the job market, with periodic spikes back and forth if oil prices are doing something particularly dramatic. And we guessed that after this survey had posted a pretty strong reading, I think it was the strongest reading in a couple of years, basically since the crisis, suggesting that this is also helping to underline that there is improvement in the job market. And then we saw it dip very strongly a few weeks back, and that is likely on all the least news and this tremendous spike in gasoline prices. And now that we've had an even further spike in prices, it's interesting to see this comfort index climbing again. It suggests some underlying strength there in the economy, being able to head higher despite those gasoline prices, which are reaching close to that $4 level in most places in the U.S., which is a big psychological level. Themes on the dollar, it's still fairly weak. Even a bit of risk aversion coming in today, not doing that much to support the dollar, as the general consensus here is that the Fed is still way behind the curve. We've seen a shift in some of the Fed rhetoric. We've seen a shift in the expectations, but it's just not enough to boost the prospects for the dollar. Oil, doing its own thing today. As risk was heading off a bit, oil was heading north. At least the U.S. Grades were heading north, and it's becoming, I would suspect, very soon, if not one of the reasons for today's slight risk sell-off, a reason to be very cautious on the equity market, etc. And on that note, the U.S. equity market has been flat for 5 or 6 days now. And after all, if we're to think about what's going on in the background here, we do have tightening going on, policy tightening, whether it's China, whether it's built into the pipeline for the ECB, even the Fed. We're looking at tightening around the globe here, and that must be dealt with, as a lot of this risk rally has been on very loose policy. Another interesting milestone we're about to reach: German 10-year is closing in on this, very close to anyway, this 3.5% line. And let me pull up very briefly a chart on that. This is the bund yield, and you see this 3.5% area, a bit sticky, going back a ways. It's this line here. Tried to cross it back here, but was unable to, and it's basically defined the high since then, since early '09. So, and this here was the rundown in yields as the Eurozone crisis, sovereign debt crisis, began unfolding in late '09, and then we've seen it since then charge higher as the interest has become, or as German yields have headed higher on the idea that German growth is strong, and as the sort of the crisis is eased in terms of spreads against the more major other powers within the Eurozone bloc. And finally, the backdrop here, just as a side note, we're noting extreme complacency. We've talked about this before. Whether it's measures like bullish and bearish surveys. Also, there was some one of my colleagues talking about some newsletter measure that shows the least number of bears in X number of years, this kind of thing. So of course, also of course, volumes very light, range is very low, and this is all, I think, kind of a sort of a background drumbeat of a warning sign. Even though we're not seeing super strong action in this yet, I think complacency usually sort of stores up energy and ends up being expressed as a more volatile move further out, or builds up into what turns out to be a very volatile move further out. And the question is, when is further out? There's an old saying, in May, go away. I think it is for the equity market. So maybe we're looking at something similar to last year when the it was around the beginning of May that we saw this huge meltdown, flash crash, what have you. On that bearish note, just more mundane, looking ahead here for the immediate future, we have the first interesting survey out tonight from Japan that covers the March time frame. Let's see what kind of survey numbers are coming out there. Unfortunately, they're being struck by another earthquake here today. Not aware of any signs that this has been damaging in any way, even though it was a rather powerful earthquake. UK PPI input-output figures out as well. Switzerland employment report, Sweden industrial production numbers, Canadian employment tomorrow as well. That's one of the bigger numbers. And of course, the ongoing debate on this U.S. government shutdown. The impression changes by the hour. The latest news I heard is that the House passed some resolution that Obama said he would veto if it wasn't changed. And the question is how much one side or the other wants to make a point. It would seem to me that the risk is larger going into the mid-May time frame when we have the debt ceiling. So we may get compromised. What I'm suspecting is we may get compromised from the Republican side for the very short term here. Even if we do see a shutdown, it may not be for more than a few days. Basically them making their point by causing a brief shutdown, but then a mid-May confrontation that if they feel that it's been a successful exercise, where they press their case further. Just total conjecture there. Follow the news. Follow the news on this situation as the weekend approaches, of course, and as the session expires tomorrow. You can follow me on Twitter at John J. Hardy. Please add me to your stream. The more followers I get, the more I can justify investing for the resources and all manner of content which I'm looking at present. I appreciate everyone who's followed me so far, and feel free to send me your questions. Should any arise, I do generally address any mentions on Twitter. Let's see. Heading towards the charts here, Eurodollar we sent out an idea looking at the long side on Eurodollar as long as we stay above 142.50. Just the general ability for this 142.50 level to survive today after the event, and the amazing ability to shrug off the Portuguese bailout, etc., leads us to believe that the momentum is still there in this market, possibly for a test of this. Was beginning to look like an ascending wedge formation, which ironically in the longer term or in the bigger picture could be a rather bearish formation if that's what it is. But short term, it just seems like the momentum is there. So we'll see what happens. It's certainly close to the support, so an idea we thought worth mentioning. On cable, we're not really seeing support for this in terms of interest rate spreads, what have you. We're still in a range. If they can get above this high here in the 164 plus area and hold, then we have to talk about that. But for now, it seems to be range bound. And what does not make sense in terms of that view and our Eurodollar short-term view is that, if we add it all up, is that we're still a bit dubious on the Euro sterling rally. We've got a bit of a breakdown here. Let's see if this 88 area holds, though. That's a 618 Fibbo. And you'd like to see this 87, what have you, level taken out and close below to get further traction on this apparent sort of breakup of the previous trend here. Euro Swiss on the risk coming off today, sort of failing to maintain that 200-day moving average. That's the area of interest there, and I think this is going to be a reasonable barometer for risk. So keep your eye on risk markets if you're looking at Euro Swiss. Finally, seeing some consolidation in the yen crosses today. Not really any specific news flow to report support that, but possibly the ECB meeting serving as a cycle or event risk that sort of stopped the cycle momentarily. Let's see what happens. It's a pretty decent volume on the sell-off, but there's a lot of room to find support. So this could get or stay plenty volatile after the absolutely enormous move we've seen to the upside. There's your latest May Brent crude price. The WTI, USD WTI grade was up even more today, although it's still a huge spread and it's much cheaper than Brent. Dollar Canada, not much interesting going on today. Slightly more interesting in Aussie, as we saw the rally in a fairly sharp reversal. We have a little bit of a divergence here, as is often the case when you get a short sell-off and then a brief run-up, but that's not confirmed yet, and I would say let's see, excuse that message. Let's see what we're doing here, and there's still room in the bigger picture for a rundown to the 102 area without exactly destroying the upward trend here. There's Kiwi dealing with the top of the range, slightly above 78. All kinds of interesting messages coming on here because I've just lost my connection, and I will pause briefly until I get it back. Pardon the interruption there. That was, mind you, that was not a Saxo Bank error. That was my global desktop or my connection for all applications going out there. So Aussie Kiwi, interesting to see the 135 test, and an area we've identified as being of interest for keeping up the idea that we're headed lower there. As you can see, even though we're seeing a bit of a risk consolidation today, this is not affecting necessarily emerging market trades, though we have to say MEX is sometimes seen as a petrocurrency. Still, if I look at dollar ZAR, it is also down on the day, so that seems to be holding water for most EM trades. Finally, on our last series of charts here, S&P 500, again, not really going anywhere the last 5 days. It's struggling with the idea that possibly that it's at the top of the range. Is there enough to drive it higher still, with oil prices doing what they're doing, etc.? Here we see the Bank of England's lack of a move today, pushing the sort of the short-term view up, or about the year forward view up another 3 ticks or so, 3 bips, if you will. Similar 2 or 3 possibly max on the ECB view after Trichet's performance today. And one idea that I think is rather interesting, and also how it was expressed in the market today, was we do have interest rate spreads supporting this very much Euro Aussie to the upside. Now we have this, what I think is possibly a misleading chart formation because it was triggered by a very one-off, and let's hope very one-off, earthquake/tsunami situation in Japan, which caused quite and this is the case in many markets, whether it's equities or Aussie dollar or various other asset classes, caused quite what if you didn't know what was happening in the market and you were just looking at this purely from a technical point of view, this reversal looks very ugly after the run-up. But I would suggest that really we don't know what would have happened without that situation, and I find it interesting on an interest rate view, spread view, that we should be higher, as well a bit interesting on the day of the ECB that we test the lows here, which are 2-week plus lows, and coming well off those. So of course, if we close back below 136 in the days ahead, that's puts us off of this as an idea to the upside. But otherwise, I think an interesting idea going forward. And the euro does look reasonably strong in today's trade. That will about do it today. Stay on your toes as we have this situation with the U.S. government approaching, and let's see how the euro does into the weekend, if that 142.50 support survives, and if it does, where we end up heading to the upside. Be careful out there, and we'll be back tomorrow with another edition of the Video FX Update. Thanks.